Welcome to Educational Alpha. I'm Bill Kelly, CEO of Kaya and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe.
In this episode, we welcome noteworthy guest Thomas Deinet, who joins host Bill Kelly to discuss the fascinating journey of the Hedge Fund Standards Board and its mission to establish industry-wide standards. Thomas takes us back to the pressure faced by the hedge fund industry during the financial crisis, the birth of the Hedge Fund Standards Board, and the importance of transparency and collaboration in improving industry practices. You'll be privy to an insightful conversation about investor education, regulatory challenges, and the future of the financial services industry. Listen in.
Thomas Deinet, welcome to Educational Alpha.
Delighted to be on.
A lot to cover here, and you are the poster child for partnership, both in substance and form, and I'm going to get more into that in terms of what we're trying to do together and why I think we need to have more of that in our industry. And certainly a lot to cover, Thomas, in a very interesting inflection point in the markets. But before we get there, maybe a little bit about your background, maybe culminating with SBAI, and we could take it from there.
I have a background in industrial engineering. I grew up in Germany. My first employer was an famous energy trading company, then moved on to work in management consulting for many years, where one of my projects was actually to help establish the hedge fund working group and run it and establish the organization that came out of it. And here I am still running the Standards Board for Alternative Investments. So that's probably a quick high-level summary of my journey up to here.
And are you an attorney as well?
No, I'm not an attorney. Many people think I have some legal background, but I can fudge it.
I think in your and my role, so much of what we do, I think sometimes they should confer legal degrees upon us. So maybe like me, I thought you might have had a JD too. Before we get into SBAI, though, the energy firm was Enron, which is interesting. And I know this was maybe your first job out of school, so certainly not in Skilling's inner circle by any stretch of the imagination. But I think back on my early jobs at Price Waterhouse as an example, as a CPA. And while Kaya didn't even exist back then, I think it got me sort of formative thinking around the importance of credentialing. And I wonder, given what went on at Enron, a lot of people were scorched, certainly investors, debt holders, the public markets, vendors, and employees as well. And I wonder if that left any formative thought as to what led you to where you are today, because you and I are both, as I said earlier, in the transparency business.
Well, that's an interesting question that I haven't had in that shape before. But in a way, before joining in Enron, I studied a little bit the stock exchange blogs about Enron. And there was one particular poster on Yahoo Finance or whatever it was called at the time, being highly critical of Enron's balance sheets and delayed cash flow statements. And I took that to heart and really delayed my signing of the contract with Enron quite significantly, just in looking deeper into things. At the time, I didn't CFA or Kaya or other credentials, so I wasn't quite a balance sheet expert. I should have looked deeper, I guess. One lesson I learned for sure is to diversify. When I was asked where I would like to save my pension in Enron stock or in a fixed income savings vehicle, I chose the fixed income savings vehicle to not over-concentrate by having already a job with that particular entity plus saving in the respective stock. It didn't help. I was only with the organization for 8 months and it faltered fairly quickly then. So my pension never ever vetted in any respect. Also, I didn't make it into the inner circle of Jeff Skilling or any of the other leaders at the time. So I had no particular insight as to what was going on. But it was a key lesson about the importance of investor due diligence, ops due diligence, in fact, due diligence of employers. Not that it harmed me or hurt me in any way. It was a very interesting and fantastic experience to see and experience it from the inside. But certainly you could argue I took lessons away and a sensitivity for issues and risks that I probably didn't quite have before, where Enron was considered a fantastic employer with fantastic graduate program and opportunities for young folks coming straight out of school.
You certainly survived and thrived. And we talked a little bit, the virtual green room, about the formative stages of SBAI. And that was not even the founding name. But if I got the story right, you were working for a consultancy and the concept. And I'd be curious to know whose concept it was and who came to you to think about this new platform. But thinking about an LP standard-based organization, you wrote the job description, became the first and only executive director, who is now SBAI. So maybe a little bit about the founding principles, which I think are reflective of what you're doing today.
Yeah, and it's good to go back in history occasionally just to see the way of thinking at the time. I mean, this was 2006-07 when the pressure mounted on the industry, on the alternative investment or specifically hedge fund industry, in terms of policy leaders being very concerned about financial crisis. And they were probably right in foreseeing a financial crisis at the horizon, but wrong in pointing at the hedge fund industry in specific as causing this crisis. Nonetheless, at the G8 summit at the time, policy leader tasked the industry to come up with standards and respond to the concerns leveled at the industry. And I think it's a great sign the industry stood together, put a project together to address this through standards. And these were the standards that we then developed. I was at Oliver Wyman at the time as a management consultant, and were published and publicly consulted at the end of 2007, while the financial crisis started to unfold. We had over 200 consultation responses from central banks, asset managers, regulators, all types of entities weighing in on the right way to frame and set standards for the industry. And then the financial crisis unfolded. We made it to the front page of the FT at the time with the launch of what was called the Hedge Fund Standards Board. And thereafter, obviously, authorities took a strong interest in the work we had undertaken, but also we took off in terms of bringing investors on board, more managers on board, to form this organization, which is now a collaborative platform, bringing managers and investors to the table to determine how good practice looks like, address the key concerns and issues that the industry faces. So it has really grown into a fantastic body of engagement.
Just maybe one other formative question. So what body or person came to Oliver Wyman and said, we need somebody to figure out X for us, and X became the Hedge Fund Standard Board? Who was the client, or was this just within the guts of a think tank of Oliver Wyman?
No, this was actually Sir Andrew Large, the first chair of the Hedge Fund Working Group, how this initiative was called. We had a group of, one might call it grandees of the London and international hedge fund arena. Oxif was at the table at the time, Brahma Partners, Marshall Wace, Man Group, GLG, Lansdowne Partners, many, many others who were at the time the dominating firms. There was certainly a certain European-centric bias to the initial founders, but it was always very international in nature. And we saw that with the subsequent sign-up of new managers, in particular investors coming on board, given at the time in the United States, there was a similar process, the so-called President's Working Group, that was also looking specifically at hedge funds and the standards and practices that would be expected from that industry. Now, fast forwarding from there, let's say into 2010, 11, 12, we, for example, see in the AIFM directive that was issued here in Europe, a lot of our fingerprint all over this in terms of all the areas that work well in the directive. They were in a way sourced in terms of concept from our standards, obviously implemented somewhat differently and not always covering all the aspects we cared about. In a way, it was very influential in that respect. And this was something regulators took seriously because it was developed by investors and managers with great input from all around, setting a blueprint good practice should look like in alternative investments. And it is up to today. We have obviously updated the standards many times, consulted on a whole range of topics to improve practices. This is really a case in point for an industry-led initiative to determine practices, how to improve a marketplace, which at the time, and we are still focused on an institutional marketplace where we have the real leading allocators, institutions at the table to help us shape this industry going forward.
One observation that I was not aware of, but I like a lot, some of those names you mentioned early on in that response, Thomas, are more globally recognized GPs and managers as opposed to investors. So I think this is an even better value proposition where you had the managers getting together saying we have to have some rules of engagement, some standards that are going to yield better outcomes for the investor. And I always thought that this is more of an LP because I've gone to some of your events and clearly LPs and GPs are there together, but I've always thought it was more of an LP focused agenda. But it's great that the GPs were the founding principles. Do I have that right?
You're absolutely right. It was initially managers who came together under the leadership of Sir Andrew Large at the time. and with great support from the regulatory community as well. But the first decision that was made after, and it was a recommendation even in the final report we produced at the time, was to bring investors on board and have equal participation of investors and managers in the governance and ultimately the membership of the organization. And that's how we today have more than 6 trillion in allocator monies, in excess of 2 trillion of managers signed up in relation to their alternative investment activities. So it is that type of balanced outfit as it was designed to be at the outset.
Yeah, well done. So maybe fast forwarding a little bit to the here now, feel free to go back in terms of perspective. But I think you and I have known each other for the decade I've been at Kaya, which was, I guess, when I joined, it was the 50th anniversary of SBAI now being 15 years old. And then we finally, I think, inked what was obvious, which was a partnership about a year and a half, 2 years ago. Maybe it was even longer, but I always feel you were a strong and invested partner from day one. But a couple observations leading up to this discussion today, Thomas. I went to that Smarty Pants ChatGPT right before we get on, and I asked ChatGPT, how many associations are there globally in the financial services space? And usually ChatGPT, if it doesn't know the answer, it makes one up out of convenience. I found it decidedly honest in that it said it's difficult to provide a number. The number is vast, evolving, and is at least measured in the hundreds. I think it's in the thousands and tens of thousands. So then I turned to good old-fashioned Google to see what Google had to say, and I got a very similar answer. They couldn't really pinpoint a number. And then the last data point, I went back to FINRA's website, and this number I remembered. I just wanted to get clarification. But on the FINRA website, they list 250 professional designations. More than half of them begin with the letter C. So what is the question behind all that noise is that we need to find ways of collaborating together. This was once a cottage industry, so one small client may need one or two services, but these clients have gotten bigger, more sophisticated. Do they need thousands of associations helping them along the way? I think the short answer is no. And I would say you and SBAI and maybe me are in a rare breed where we're saying partnership matters to me. A contract is irrelevant. Are we willing to work together? And you've always been like that. So thank you and congratulations on, I think, what is a very important attribute. But maybe how important is collaboration here as opposed to just staying in our lane and focusing on our own little shingle?
It's at the heart of what we do at the SBAI, starting with bringing investors and managers together to collaborate rather than sitting in different organizations or different rooms talking about each other rather than talking to each other. In fact, we also weave the regulators into this. We are active members or affiliate members of the International Organization of Security Commissions, IOSCO, where we play an equally constructive role in bringing our views to the table. I mean, by all means, none of the many organizations you mentioned have a God-given right to exist in perpetuity, and organizations come and go, and we have seen many organizations come and go over time or merge or turn into something else. It's all a function of adding value to constituents. That's maybe the starting point. What is the value you add? The second aspect is, yes, we love to collaborate with you, and you're a special partner of the SBI. Just because you're so aligned with our mandate. We are standing for strong industry standards, robust practices to the benefit of investors, to the benefit of the end users, the pensioners and others who are ultimately saving through all types of investment products for their pensions and otherwise. You are a professional body focusing on the individual. So professionalism goes hand in hand with strong standards. So I guess unless we were to invent another Kaya, which we have no intention to do so, the approach is for us to obviously collaborate. It makes perfect sense. Now, there are many other organizations which we call partners out there, the International Forum of Sovereign Wealth Funds, which is an organization that caters to the sovereign wealth fund community with the specific needs they have, but they're also investors in our ecosystem. Hence, we have a lot of sovereign wealth funds as members from around the globe who are equally members of the IFSWF, the International Forum of Sovereign Wealth Funds, or the FMSB, the FIC Market Standards Board, Fixed Income Commodity Market Standards Board, which is an organization that rose out of the banking industry in 2014 and in a way set standards for banks in a way, almost using the blueprint we had established here at the Standards Board in terms of a standard setter and collaborative platform. We like all these organizations. They all do their particular job in their corner or in their particular part of the industry. And let's face it, I mean, there are very specific professions, whether it's risk professionals, legal professionals, ops DD professionals, etc., that maybe act across many different financial services sectors who might want to have their own professional bodies if they like. And there could be particular pockets of expertise and activity in alternatives where the respective industry feels they need to have their own platform. So I'm not, in a way, necessarily a proponent of consolidating everything for the sake of having the Uber body, if you like. I mean, there's a lot of initiative, a lot of people with drive who want to build something, and I wouldn't want to put stumbling blocks in their way if they feel they can do their own thing. We are just open to collaborate, and in a way, we have seen us grow, become stronger by virtue of focusing on catering to our constituents, the managers and the investors, and ultimately the public at large in improving practices. So the collaborative model works very, very well for us. And there have been collaborations that were 5 years ago and that have gone away for whatever reasons, and others that are emerging with you that grow ever stronger.
Well said. And my only competition is opacity and ignorance. But I do find there are a lot of associations that start with what's in it for my members. And I say, well, let's talk about what's in it for the end client. And then we can walk that back. And you're a like-minded thinker there. So thank you, Thomas. So a follow-up, you mentioned IOSCO. When it comes to standards around best practices or approaches to doing X, Y, and Z, that's not easy, but you can at least write down on a sheet of paper what those might be and reach some consensus, and hopefully everybody follows it. But then you've got 190 some odd countries in the world with different capital markets, different regulators, and we have not harmonized regulation, and maybe we can't and won't. But I think about the emergence of digital assets, and that means a lot of different things to different people. But even the PE model and real estate and virtually any asset on or off chain can be tokenized and buy shares in it. So if I think about regulation, I would have to think when it comes to some of these emerging trends, we're going to have to find ways of greater harmonization. I assume you don't get probably too deeply involved in trying to influence regulation, but do we have to have more harmonization from a global regulator standpoint? Because the investor is sort of passport agnostic looking into these markets. I think there's a question there, Thomas, but maybe your thoughts on harmonization of regulation.
I mean, first of all, the Standards Board is through its IOSCO membership, but also through consultation responses, direct engagement with authorities. I mean, we met one central bank, two major security regulators, actually three, and one finance ministry over the last 2 weeks. So we are quite actively in dialogue with various entities around the globe and have obviously responded to numerous consultations. Our strength is we start out from our set of standards and argue on the basis of our standards in terms of what is good or bad practice and what works and what doesn't. I think this is highly appreciated. And we also often manage to get investors to speak up in the context of regulatory initiatives. The investors are the users of the industries and often supposed to be the beneficiaries of regulation. Therefore, it is so important to get the investors involved in this dialogue because they obviously have a word to say on whether the proposed rules on private funds in the US really help them, or whether short selling bans and restrictions in Europe are actually the way to go. So that was a key success factor for us to, in a way, carry the message with a broader constituent that we reflect on and we stand for. We are representing the ecosystem here and certainly want markets to function and want financial stability, etc. But we bring a different angle to that. So we are very actively involved in that. It is very tricky to achieve harmonization. As much IOSCO stands for harmonization of rules, and they set standards at the top level with a view to jurisdictions hopefully falling into line. They have also memoranda of understanding that they facilitate between jurisdictions to help with enforcement and investigations. But the reality is each country or most countries are democracies where we have a bottom-up process of decision-making around what the rules should be. And it's very difficult to say we have a technocratic overlay here of experts who know better than the democratic process in the US versus Europe in terms of their prioritization of rules and regulations. So hence, IOSCO can play a very important role in paving the way, in creating common understanding, but it cannot guarantee that there are democracies around the globe in a way do what IOSCO deems right. And in a way, that's okay. I mean, we appreciate and like and love democracies in action. Hence, that's the way it is. Now, it creates specific challenges, obviously, in different markets. We see it in the context of ESG regulation, if different standards occur, different reporting frameworks arise, it makes it very difficult for global investors to harmonize that. We have even seen that with the reporting templates for alternative investment managers from PF in the US, AFMD Annex 4 in Europe, which don't even add up if the regulators want to aggregate the data they collect in the various jurisdictions because they have different definitions, etc. So yes, there's a strong desire and need from everyone for more harmonization. Maybe just before I get into the digital assets arena, we look at the world through the very high-level principles that we hopefully all agree to in terms of the outcomes we want to achieve. And maybe the FCA principles and principles other regulators have set are a good example of what regulation ultimately should deliver in terms of outcomes. Then come standards, which maybe formulate this at a very, very high level, or at a higher level, still in terms of the desirable outcomes, and only then come the detailed rules. The trouble with detailed rules, and we see it again and again, is that they are enshrined in regulation forever, but often the half-life of what they are seeking to address is much shorter and new issues arise. And then you need to create ever more rules to cater for every possible scenario. So rules are very suitable for things that do not change a lot, like the registration of entities, etc. Reporting template needs to be very specific and predefined. But there are other things like governance, risk management, etc., where in a way a very rule-centric approach creates tick-boxing mentality, but not necessarily better outcomes. And that's where we come in through our approach of standard setting. Now, digital assets is a particular challenge because obviously it creates a global playing field through the technology and a notarization technology of transactions in a world of no trust, if you like, where you can transact with anyone everywhere and you can have the underlying machine or the algorithm provide the trust. Now, when regulation comes into that space, obviously, it can result in fragmentation. And that's what we discussed, in fact, at the last IOSCO conference, how it works at the end of the day if every country has different definitions and approaches, and it defeats almost the boundaryless nature of what the technology enables. But you also have to think from the perspective of a retail protection regulator who might not want someone in a particular jurisdiction to participate in an offering of something in a completely different jurisdiction that doesn't quite live up to the investor protection requirements in that jurisdiction. So it is not so trivial. I can see how compartmentalizing or turning things into smaller units to enable transactions more easily. You mentioned private equity secondaries. These are fantastic ideas, and I think there will be a lot of innovation around these things. It's just at odds with regulation coming in, actually creating a world of trust by virtue of regulation that can be enforced. Theft of assets, etc., can possibly be addressed in a regulatory world. So it remains to be seen where this world ends up. Maybe there will be a couple of big jurisdictions with digital assets regulatory framework that will dominate the world. And for most players in this area, it might not be viable to adapt their approach to every single jurisdiction around the globe. So we'll see to what extent jurisdictions fall into line with others as a function of the desire to enable these type of activities in their marketplace. We as a Standards Board for Alternative Investments have not necessarily opined in detail on specific regulation, but we have taken the perspective of investors in terms of helping them undertake due diligence of digital assets and crypto assets and investments in that area, and also understand the risk profile and the differences in risk profile between, let's say, classic custody as we know it, with central securities depositories and custodians on top, versus the world of custody in the digital assets world, where really the risks are very different despite the same label of custody. So I think there's a lot of work that can be done to help investors understand risk. As a Standards Board, we are also agnostic. We are not promoting or endorsing any particular area of investments, neither of any of the other strategies of firms that are signed up, nor in the digital assets arena. And I think that has served us well as a neutral player that accompanies the ecosystem in improving outcomes to the benefit of all involved.
A very good summary. And if I think about the word government, it's very hard to use that word in the same sentence as innovation, maybe with Singapore as one of the notable exclusions. And I think about regulatory system, and this certainly speaks to the SEC's mandate here in the US, it's to protect the investor through regulation. And I think ultimately we got to teach them how to fish, protect the investor through education. So don't try to rinse out the value proposition that might be in private equity through democratization or secondaries through democratization, or even put cryptos aside, digital assets through blockchain offerings, and equip the investor with enough knowledge to understand what's going on. Easier said than done. And I think it's easier to say, I protected you by not allowing you over that fence. And I think generationally here in the U.S., this concept of helicopter parents in my generation, if you shelter the child through their teenage years and then kick them out of the nest, they're ill-equipped to deal with some of the challenges that they're out there in this world that can be very, very difficult. So maybe a lesson learned both for a parent and also maybe as an investor. So Thomas, in the remaining minutes, I want to talk about the state of play of transparency, which is at the heart of your mission and my mission. I think I even said at the very beginning of this podcast that we're in the transparency business. And I speak at a lot of conferences, as you do as well. I was in Chicago and St. Louis over just these last couple of weeks. And the concept of GPs using lines of credit to fund LP subscriptions, known as SLOCs, GP-led secondaries, which has some criticism because these LPs are given very little notice to roll into the next fund. I heard an interesting case about asset stripping, where the assets in one PE company was stripped and put into another and left the debt holders maybe a little bit wanting as well. So not asking you to comment on any specific of those points, but it would seem to me, and maybe I'll put greenwashing on that list too to complete the narrative, that if all of the assets are being held by the LPs, they seem to have the ultimate monopoly to say, this is what the rules of engagement must be. But it doesn't work that way. And it's more complicated and nuanced, and manager selection matters a lot. You've got access to a manager that is not taking new mandates. You don't want to necessarily run afoul of that relationship either. But to say transparency and the LP has all the cards is just naive thinking. But maybe your views on where we are in the state of play. And it's never going to be perfect. Jack Bogle talked about two masters that are served, both the shareholders and the partners of the GP and the client on the other side through a fiduciary principle. But what's your view? Because you've got a very good perch in terms of where we are and how things are working.
I mean, over the 15 years and more that we have been observing this marketplace, we can obviously tell there's a pendulum that is swinging back and forth between investors and managers. Ultimately, it's different pendulum almost in different marketplaces. I mean, specifically in the liquid alts arena, we have seen investors very successful in driving better outcomes and practices over the last 15 years, also with the help of organizations like yours and the Standards Board here in enshrining certain practices and the standards to which the managers sign up and giving investors a benchmark of good practice, where that relates to the handling of redemptions in situations of liquidity distress, which we addressed back in 2010. And I can see it still features here and there on the regulatory agenda, or whether it is conflicts of interest in parallel employee and partner funds, which I wouldn't call stamped out, but we certainly put standards and practices into place that would crystallize it and make it visible to investors that there's a very blatant and obvious conflict. So yes, disclosure and transparency is the first step to enable investors to make well-informed investment decisions. You kind of also hope that we can, through standards, enshrine certain minimum hygiene norms almost in the industry that one shouldn't really fall below, because this is just the way good practice should be, and not following this good practice really backfires for the entire marketplace and damages all involved. Obviously, no one can quite control what every individual investor is doing, and there's a wide spectrum of sophistication. So for us, a key mission has been through the SBAI toolbox, which is actually public on our website. One just needs to create a little account with SBAI and sign up. A lot of resources for investors to conduct due diligence on ESG-related matters and different strategies, on co-investments, on cybersecurity, on the governance arrangements, on the valuation arrangements of ILS funds, of credit funds, you name it. We have guidance with key questions for investors to ask, but not just a tick boxing exercise, but truly to engage in a dialogue to understand. That's really the precondition here. Yes, there's dispersion in terms of practices, education levels, and power in this. And we are constantly pushing ever deeper into the private markets arena. As you know, we currently have a private market valuations working group that seeks to address key information asymmetries that exist between the investors and managers in the PE and illiquid arena to help investors really ask the right questions, get to the ground of issues, and ultimately drive better valuations, better practices, and more consistency in that area. That's the way we approach it. And possibly the private equity arena has been an area where there has been a lot of capital influx over the last 10 years, a lot of demand, where maybe the pendulum had been far out with managers having a lot of power and very little incentive really to work on certain practices. I'm not suggesting at all that every manager in that area is not up to scratch, and there are fantastic managers that we know and that we have involved living up to great practices. But I think that is the way markets often operate. Investors also come often to us with questions or complaints about fees in alternative investments. But we are crystal clear on that. We are not interfering in the price formation in a market where there's a lot of competition, and investors can just choose not to invest if they're unhappy with the cost of whatever they are confronted with. And I have that with many things in my life, that I choose not to buy them because I can't afford them or they're too expensive. Hence, that's just the normal mechanics of market at work. And we are not getting ourselves into that. But if it relates to standards, practices, fair treatment of investors, that's our home turf. And we certainly do care about better alignment between investors and managers.
A very practical summary. And I'm going to conclude, Thomas, with a bit of an infomercial. It's rare I get commercial on this platform, but you've been kind enough to invite me to several of your forums around the world. You've allowed me to speak directly to your board of directors, which was the highest of honors. And then you've got an forum coming up in September in London. And I'm in Croatia on holiday. And I even asked my wife, Liz, could I buzz over to London? And she basically told me, I know in certain terms that wasn't happening. But my seeing a colleague, Laura Malini, will be there representing us quite well. But I will say to the listeners that this forum is excellent. It's very rich in content, but the ability to get to know each other, LPs and GPs, so a little bit more of a social agenda that's mixed in. So if this has any appeal to any of the listeners, certainly feel free to reach out to myself or Thomas. It is an outstanding platform. So Thomas, well done. Happy 15th year anniversary. And I remain hugely appreciative of what you do and the partnership you've brought forward, as I said earlier, both in form and substance with Gaia.
And I very much look forward to continuing the great work, the strong alignment and the joint activity, including with the joint activity or event around our AGA in September. So thank you.
Outstanding. Well, I'll see you some point in the fall. Thanks, Thomas.
Thank you.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Gaia Association and subscribe to the show at Gaia.org. That's CAIA.org. See you next time.